Today, how much further will the markets run? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Today, I'm joined by Steve from the US. Hi, Steve.
Hi, Martin. Thanks for having me back.
It's great to have you back on the show again. And we chatted a few weeks ago, actually, and we thought that then the markets were pretty much overdone. They're going higher. Everyone's reaching new highs. Now, from a macro perspective, what's going on, and is this sustainable, do you think?
Absolutely not. This is definitely momentum chasing momentum. Investors are getting really bit up by high frequency trading. I don't think a lot of people really understand what's going on in the markets. Is we've seen a lot of these firms, and even in my own professional matter, we've seen firms go to zero trade fees, and everyone's like, "Oh, yay, zero trade fees." It's like, "Oh, wait a minute, nothing is free in this world." And what's happening is this order flow is hitting the market, and it's being front run by computer algorithms called high frequency trading algorithms. And people are just paying more. And I kind of use the example. It's like, well, what if we went to the drive-through and I went there and I paid a price and then you behind me paid more? Would you be happy? But hey, people are happy about it. So no, it really doesn't make a lot of sense. The markets are going up, but what it's all being mainly driven by is just hot money chasing hot money, and people just don't care about valuations. Yeah. But if you look at the bond market, it's telling you a completely different picture. Is something's going to happen, and it's going to be very, very interesting, and it's not too far off.
Well, let me just unpack that. So high frequency trading, I mean, I did a show some time ago when I was explaining frankly, the wars that there are out there to get closer and closer and closer to the exchanges, right, and have bigger and bigger communication cables, because there are, those large institutional players who are micro trading, right, and effectively outbid everybody else in terms of frequency and speed, and they can move much faster than everybody else. So they're the winners. And for every trade where there's a winner, there has to be a loser. And my observation is that many of those losers are your more normal traders who have actually got their trading accounts quite recently. They've got their checks from the government and they've now put it into the market, right? And they're losing.
That's exactly what we're seeing is. And I was honestly kind of surprised by this, but now that I look back, because a lot of people, when they don't understand the markets, there's so much psychology that goes into this. And you have to go back to what did we think was going to happen in March and April, is everyone thought, I'm going to be back to work. I just kind of got an extended vacation here, and the government's paying me a lot of money to sit at home, and I don't need it. Yep. So they deferred a bunch of their loans. We saw, at least in the US, and I'm sure it's probably true just in Australia, there was 100 million loans, not dollars, loans that went in deferment. So people were just throwing money in the markets, and the high frequency trading programs were doing their job. And then all of a sudden it's starting to get clear that, oh no, people aren't going back to work. Their employer closed or jobs are going away. And I think that this whole tide could easily reverse in the other direction, because, let's say I'm sitting down with my wife at the table, and, I've got some loans that are now going to restart where I have to make payments. My unemployment benefits are now below where they were before. Is there going to be a conversation of, well, maybe you should go sell that Apple stock or whatever you put your money in, because we need to pay these bills? And that very much could happen. And you almost sense the U.S. government's panicking a little bit about getting money back into people's pocket, because they're going to have less money. And yeah, that could lead to a reversal. And definitely, as you mentioned, with the high frequency trading algorithms, what bids prices up bids prices down. And what I don't think a lot of other people understand, and I know you understand from as you said, how close they are to the exchanges, there's another piece, and I'm not sure if you know this, but the law used to be about the best price. So when I put a trade in, the market had to give me the best price. Today, it's not true. It's fastest execution. And what we've seen, at least in the United States, because I think this is where most of the HFTs exist, is there's micro exchanges popping up all over the country just to front run trades. It's a knife that can cut both ways. And I don't think people realize March was a preview of what could happen in the markets coming forward.
Yeah. Well, there's two problems, isn't it? One is that your average investor who's just started trading on the stock market thinks it's dead easy, right? Because the market's going up, right? So why didn't I do this before? I'll put more money in because it keeps going up, right? That's the first point. The second is that, of course, we have things called dark pools here in Australia, which are effectively trades that are not exposed in the price that's available to normal traders, right? So if you're using your trading account at home, you never see those trades. They're effectively put in the dark pools, and they get the first prices. So the markets are rigged so that the professional investors will always outdo your standard investor. People don't get that, right? And the second point, just to reiterate it again, what we've seen in the last few months, this massive run up, completely stoked by the Fed in the US throwing all its liquidity in, and other central banks around the world. If you look at the fundamentals of the economy, both here in Australia and over there are some fundamental questions to be asked about how sustainable this is. And if you look at valuations of stocks, I mean, the valuations just belie the price that the markets are actually commanding at the moment.
Yeah, and what I find very interesting is so many people believe, that central banks are injecting liquidity. And the last time I was on your show, we talked about what QE is.
Yeah,
they're actually not injecting anything. They're just doing a reserve swap. And it was interesting because some of your viewers emailed me like, "Wait a minute, this isn't what I thought it was." I'm like, "It's not what anybody thinks it is."
Yeah.
And then the follow-up question is, why do they go out and say that? Because you believe it. And that's what's really central banking is at its heart. It doesn't do anything. It just makes you believe. And if you believe that somehow the Fed can buy stocks or put liquidity or whatever it is that you think that makes them go up, well, what happened is people bought stocks. Well, what caused stock prices to go up? People buying stocks. I mean, it's almost hilarious.
Yeah.
But people don't attribute it to their own purchases and the fact that what millions of accounts were opened up during the shutdown, they attributed to magic central banking. Well, it actually doesn't work that way at all. And I get a kick out of it because when it does flow the other direction, people are going to just stand there and be like, what happened?
Yeah.
I thought the Fed had this magical ability. No, they certainly do not.
Right. And so what you're talking about here is the market psychology, right? And it's the lemmings or the herds or whatever you want to say, right? Because effectively it creates its own momentum, and that momentum is actually what drives where prices go. It has very little to do with anything fundamental, right? It is a psychological issue.
Absolutely. And it kind of goes back to, and I like using Reagan as a perfect example of this, because back when he was elected, he faced a double dip recession. And as a president, I mean, that's pretty much the end. And I don't know exactly why this occurred, but the Bureau of Labor Statistics decided to fudge the numbers. Now, I'm sure there was lots of people involved in this decision. And what they started doing was inflating the employment numbers. And so all of a sudden, maybe who was unemployed was like, oh, wow, look at, Martin got a job and people were out getting jobs. So I guess it's okay. And I'll spend some money. And what happened was that money being spent created more jobs. And then a year later, they come back and say, oh, well, we were wrong by a million or two. It doesn't really matter because we made you believe. And I think investors really don't understand that, when we see people like Fed chairs and Congress people and presidents, and I don't want to say anyone specific because it's true, person after person, that all they're doing is trying to get a reaction out of people. So if I will go spend and you go spend and everyone goes spends, it will create jobs and it will lift the economy. And they'll do anything and they'll say anything to get people to believe. The problem with all of this is what happens when it doesn't actually work and we get to see that the emperor has no clothes, and that day will eventually come.
Yeah, well, of course, is it like 2/3 of US GDP is consumer? It's about 65% here in Australia at the moment, and everybody is trying to talk up the consumer to spend, right? So, buy property, great time to buy property. No, it's not. Prices are going down. Spend. You've got all this money from the government. Go spend some, right? It's all the big Ponzi, right?
Yeah. The consumer here is at 70%, so pretty much right on par with Australia. And I would imagine that's pretty similar in Europe and other major countries. And it's interesting to me is we gave people all of this money. And if you look at the retail sales growth, yeah, it jumped, but not as much as you would hope that it did. And it starts to make you wonder, and I'm really curious to look at the high frequency data as we come in the next few weeks here in the US. Without that extra money, I'm expecting the numbers to just tank. And I do believe, President Trump is concerned about it as much as the Republicans and Democrats. They just can't get an agreement. But if you can't get people to spend when you give them more money, what's going to happen when they have less? And they didn't even have to pay on many of their bills. That to me is frightening.
Yeah. Well, we've got the cliff. They sort of tapered the cliff here. Originally, it was going to be September. Now it's further out. But there's a whole lot of negative indicators. And in fact, forward here in Australia, the amount of stimulus that's being withdrawn is quite remarkable over the next few months. And by the way, we've just got another lockdown in Melbourne, which is a quarter of our economy. So, it's not like COVID's over. So I share with you the concerns about the fact that what happens when consumers don't do what everybody wants them to do, because they're actually a bit more open and alert to what's really going on, right? Maybe they're watching shows like this and like your show, right? People actually understand more about what's really in play rather than the high-level stories that the mainstream media keep trotting out and trying to encourage people to buy more. But look, let me turn the conversation back to bonds, because you made a very interesting observation, and I can't let you get away without unpacking it further. Something's happening in bonds. There's something weird going on, isn't there?
Well, I wouldn't say weird as much as, everyone fixate on the equity market, and I get that. It's exciting. The bonds are boring. Sure. But the bonds are the true sayer of the market. And around my house, we have the phrase, who is the sayer of truth? I always like to think that's myself, but my wife, I'm sure, would like to think that she is sometimes. Well, in the markets, the bonds are the sayer of truth. And what we see right now in the 5, 10, 30-year bonds is they're on the cusp of breaking down a massive technical support level. And it's a minor technical support level in a massive structure, multi-year structure. And people go like, so what? Well, what happens is when bonds start to break down, they're telling us something very important. In fact, the late, great Milton Friedman, the economist, he didn't have time to solve this, but he theorized that low interest rates are a symptom of tight financial conditions. Now, nobody believes that. I mean, when I tell people that, they go, what? I thought low interest rates meant financial conditions were easy. No, it's quite the exact opposite. So the bond market is telling us the economy is tightening. Now, the risk there is the market is naturally short bonds. I mean, we see there are speculative shorts, but if you're long stocks and you don't own bonds, you're short the bond market. So what happens is when bonds yields start to fall because the economy is tightening, then all of a sudden stock prices start to come down, and then you have this massive rush out of equities because they need some insurance because they didn't buy it. And so I look at the bond market right now and it says yields are about to completely head down to zero, and the market is not prepared for this. This is exactly what happened in the great financial crisis. And yet we're just kind of replaying the thing over and over, and nobody sees it.
It's Groundhog Day.
Yes.
And we haven't learned. That's the thing that I'm most frustrated about, Steve, is that we're making precisely the same mistakes that we made previously, and we're making the same assumptions, and we're making the same, central banks will save us sort of thing. We haven't learned. What we're doing is just throwing more petrol on the same old problems. We haven't started to tackle the fundamental structural issues that will actually, take us a generation to work out, I think.
Right. And if you look at what central bankers are doing, and so people kind of, if they hear my view that I'm long bonds and that I really am a strong believer in bonds, they go like, how can you not be in the equity market? And it's simple. My whole thesis is, as you just point out, one, we haven't learned anything. Number two, we're doing the exact same thing we did in the great financial crisis, except we're doing it bigger, and everyone thinks it's going to be different. And the reality is it's not how monetary policy works at all.
Yeah.
You'll get the same results and that's why I point to the March drop in equity prices, because it was just a preview of what is to come. And I think it's very interesting that, we have a debt problem, and unfortunately we've had to solve this humanitarian issue with more debt. And yet people think that's going to work. And the reality of the situation is if you go back to, say, the Great Depression, which is really the best model that I look at for what's coming, is the Great Depression, the decade following was terrible. I mean, it was bad. And people say, well, why didn't the central banks do more? Well, one, people lost faith in them. Number two, the solution to a debt problem, you got to pay it off. It's austerity. And boy, you tell people austerity right now, and nobody wants to hear that. But it's true. We just have too much debt.
Well, of course, they'll turn to MMT and say MMT will save us. And there's a lot of conversations going on down here in Australia about we should be doing that. In fact, maybe we are doing that, right? My own perspective is there, well, it might be saving us in one area, but it creates a whole bunch of other questions elsewhere. It doesn't necessarily take us to anywhere necessarily positive.
No, in fact, it's a big, at least here in the U.S., and I'm not overly familiar with the central banking policies of Australia, but I believe they're somewhat similar around the world. So we'll kind of lump this all together. Everybody thinks we're doing MMT. We're not. MMT is when a central bank directly purchases debt at a treasury auction. We are not doing that at all. The Fed is literally just swapping reserves and making people think we're doing something we're not. MMT will certainly not solve the problem, but if they do that, at least here in the U.S., we're going to have to see Congress repeal specific sections of the Federal Reserve Act. And if you do that, and people, I know everyone thinks it's going to be a great idea until the dollar hyperinflates a matter of months later, but that will not be the solution. That pain will be way worse than the pain of austerity.
Yeah. And it's like there is no silver bullet, because if there were, we would have used it, right? And we're not wanting to take the fundamental hard decisions that we should have taken a decade ago, 2 decades ago, to be able to put the economy on a longer term. And to me, it comes back to this, right? What we're trying to do is to stop anything failing, right? What we've actually done is we've actually given up on if you like, the idea of capital is risk. And that effectively we should be rewarding those who take risks and are successful, but we should allow those who take risks and are unsuccessful, they should fail. Whereas at the moment, what we have is basically a one-sided bet, which is that they assume that the central banks will support everybody and nobody's going to fall over, quote, for financial stability reasons. But what that does is it creates zombies companies. It creates effectively money going into the wrong places. It means that a lot of the money that has been magicked up is going into areas that is not productive, and that's the problem that nobody wants to tackle.
Yeah, you're absolutely right. Bankruptcy laws are a beautiful thing. I mean, people act like it's the end of the world, and I don't remember his name, but there was a hedge fund manager, and I think you may have probably have seen it, but he went on to CNBC one day and was like, look, bankruptcy is really good. I mean, it takes the rot out of a company, gets rid of it, and puts the power of the company into the employees, who can then go out, raise new debt, hire a new board of directors and other executives, and start over. But yeah, all we're doing is dragging this problem out, and central bankers are really hoping that this works, because there is no other solution. If this doesn't work, there's nothing they can do. And it's all a big excuse, because investors haven't saved enough. People have not saved enough money for retirement. Businesses have not planned for catastrophes. Everyone's been reliant on central banking to fix the problem. The reality is central banking doesn't do that. And we're eventually going to find out and be in a much worse place than, as you said, if we would let these businesses fail. And if we would teach people, hey, you know what? If you screw up in life, you fail. I mean, it's okay.
Yeah.
Learn from your lessons and start over. But no, we reward people who buy their shares back and run poorly run companies. It just doesn't make any sense. But there is a price to pay for it, and it's coming soon.
And just to give people a bit of a sense, in the US, my understanding is that the Fed has basically created more than about 5 point something trillion, of which about 85% has gone right the way back into bond purchases to buy back shares. Yeah,
well, I mean, the Trump tax cut did that, and I know I don't know if that was his intent, but we see that here again with the Fed is. Well, why are they buying Apple's bonds? Well, because we want an aggregate index, blah, blah, blah. Yeah, look, they need the stock market to stay up. And, even though it's not the Fed's job to keep the market up, why does that matter? Because when I feel rich, when you feel rich, well, what do we want to do? go spend money. And if my brokerage account goes up every day, then there's an increasing probability that I'll go spend a lot of money. And that's why we see that when markets go down, they follow consumer confidence, they follow retail sales, because if I've got less money, I'm not going to spend it. And so kind of de facto, the Fed has to kind of help this. But in the end, when you create a bubble, they eventually burst.
Yeah, a bubble is a bubble is a bubble. Now, let me just talk about another bubble, well, or maybe not, gold and silver. What's going on there?
Yeah. So gold, I do think is a bubble. And that is a very contrarian view right now. And a lot of people don't like that I have that view. I do think gold is in the beginning of a secular bull market. So I'm from a macro long-term view, totally bullish on gold. In the short-term view, I'm not. And the reason I'm not is if you look back again to the great financial crisis, you see the same thing playing out. The only difference is we had this real big burst of QE from the Fed back in March, and that caused real or inflation adjusted interest rates to fall. And then people just started piling into gold because for some reason they thought that was a hedge against what's going on. And that really wasn't what happened. It's the dollar weakened. And what a lot of people don't understand about the dollar right now is it's highly correlated to the Fed's balance sheet. And because of the currency swap lines getting paid off and the repo loans getting paid off, the Fed's balance sheets actually shrank. But as they continue to do quantitative easing, and I fully believe there's going to be an even bigger version than we saw in March, that is actually bullish for the dollar. So when we look at bonds, as bond prices start to take off and yields start to fall, I believe you'll see the dollar follow bonds. In fact, I've run a number of charts on my show showing that relationship, that one of the two is right. And with the Fed buying bonds, we know the Fed's going to be right. Well, if you get a rally in bond prices that is signaling a tightening of financial conditions, and you get the dollar to rally, which is a double tightening of financial conditions, you get a massive pullback in gold. In fact, back in the GFC, we saw about a 30% pullback. It turned out that if you were in bonds, you could have sold your bonds for a profit, bought gold, and then you could ride the next couple of years up and make a fortune. I think that happens again.
Yeah, and as you say, a contrarian view. I get a lot of people on my show saying, why am I so cautious about gold? Because I am relatively cautious, and for the reasons that you've articulated so well. There's more going on here. Plus, of course, the fact that the gold underlying relative to all of the derivatives is as a one-to-many relationship, right? And there are so many people speculating around that as well. So this is not a clean commodity. This is effectively a very scrambled commodity, and there are many more risks in it than people, I think, perhaps are fully aware of. And what I keep saying to people is, don't put gold on a pedestal and say it's magically going to insulate you from everything. It's not. It's still part of the same problem. It's priced in US dollars, as you said, and that's critical to bear in mind. It's linked to the derivatives market and everything that's going on there. It's linked to the broader speculative environment that we're part of at the moment. And it's linked, of course, to what's happening with central banks. So you can't sort of pull it out in isolation and say, well, gold will save us.
Right. And there's a couple other factors I'll add on to that is, there's a lot of margin debt under this. I mean, a huge amount of margin debt under this. And with the market so mispositioned, just like it wasn't going into the GFC, is why did people sell gold? Is it because they wanted to? No, because they had to. It was liquid. I mean, when all things go bad, if you've got gold, there's a buyer for it. Now, it may not be for your house or for your other stocks, but people will buy gold, and they had to sell gold to cover their shorts. The other factor is everyone believes real yields are going to keep going down. And my view is we're going to see a big crash in consumer prices at some point, because I think they've been propped up largely by these government transfers, but there's nothing beyond that. Because if you look at the relationship between consumer prices and treasury yields lead consumer prices, which would imply that if I'm right and yields crash to zero, consumer prices are going to follow it. But at that point, you're going to see yields rise as the smart money unloads their positions. You get a rise in real yields, well, gold will crash because it's inversely correlated.
Yeah. And that's the point. If it's more deflationary rather than inflationary, bingo.
Yeah. Now, to me, that sets up a buying opportunity. But in the short term, I look at this, I see that gold is, like you said, as much speculation is going on in that as in the equity market. And maybe it will pull back even more than I think, but I think it does.
Right. So let's then sort of close out the conversation with, what's your sense in terms of timing? Now, we have an election, of course, later on in the year. That may or may not be significant. We know that the Fed is probably going to do some more stuff later in the year as well, because they'll have to. The unknown, of course, is COVID and the impact of that, because that's still raging in some areas. So this is a really, really uncertain time to try and actually make forward views. But what's your sense of the next few months?
Actually, I think the next 60 days is going to be very interesting, because the bond market is the leading indicator. And like I said, nobody looks at it, but they should. I mean, if you want to study the market, study the bond market. It answers all your questions. And if you look at a chart of, say, 30-year Treasury yields or 30-year Treasury bonds, either one, you see it on the edge of this massive move. And who's driving that? Is it the election? Is it the COVID? No, it's the Fed. The Fed is buying bonds. They're taking bonds off the market. And that's what a lot of people don't realize. All the Fed is doing is they're reducing the supply of bonds. Well, they're effectively creating a massive short squeeze against the speculators. That's exactly what they did in the GFC. That's exactly how the whole thing blew apart, was the Fed squeezing all the speculative shorts that then turned into a momentum shift as people had to sell equities to buy bonds to, reduce their potential losses. The Fed is on the edge of doing it. And when I was very excited, I applauded the last Fed meeting, because I was hoping and I knew that Fed Chair Powell was going to come out and extend it. And the reason I knew it is because 2 days before his press release, they released the schedule for their upcoming QE auctions, and there was no change. I'm like, hallelujah, you're going to make my thesis look brilliant. And in the next 60 days, I think something big happens.
Okay. Well, we should check back, in a few weeks, because I think you're right. I think the next quarter in particular is going to be remarkable. And I think we're going to see some significant moves in the markets. And I think many of those will be unusual and surprising to those who are not following the likes of yourself, who is really, I think, on the ball in terms of how this is playing out. Steve, if people want to find out more about you and your channel, where do they go?
Oh, they can just Google my name, and they'll find my YouTube show, my website, Facebook, LinkedIn, everything. I'm out there.
You certainly are, but you're not out there in terms of your views and opinions. I have to say that I think you are, absolutely on the nail, and that's why I love talking to you. We'll do it again very soon. Thanks for your time today.
Great. I'm looking forward to it.
Cheers.